Welcome to Apartment Market Dynamics from NPF Research. I'm Jay Parsons with your St. Louis update. If you've been following our commentary on any of the Midwest apartment markets of late, you pretty much know the general pattern. Surprisingly good job growth in 2011 and 2012, particularly in the manufacturing industry, and that led to some unusually strong apartment performances in those years. But as job growth levels have normalized again, and normalizing meaning drop back down, apartment performances have cooled off. Now, St. Louis falls into that Midwest region, but its economic and apartment performance patterns haven't followed the region overall. The St. Louis economy has yet to muster up any kind of consistent momentum, and apartment performance has been consistently bifurcated with clear haves and have-nots. And we'll get into all that. Let's start off by looking at what's going on in the local economy. Here's a chart showing year-over-year job change by quarter. You can see St. Louis took a sizable hit in the downturn, started showing a little growth in 2011, then no growth at all, actually some cuts in 2012. Now a little growth again in 2013 so far. 11,000 jobs added annually through Q3 2013, but that amounts to a growth rate of just 0.8%, which keeps St. Louis in the nation's bottom quartile for job growth. So as a result, occupancy remains pretty soft at 93.1%. It's actually dipped down in 3 of the past 4 quarters and down 120 basis points year over year. Now bear in mind, St. Louis is never a high occupancy market, but a healthy rate here would be around 94%, and St. Louis, it's gotten there at points, but just has not been able to sustain that. So rent growth has been generally quite limited. Rents were up a solid 2.5% year over year as of Q3, but the average over the past 3 years, as you can see, has been right around 2%. Not terrible, but certainly subpar compared to what we've seen elsewhere. Now, I did mention this is a highly bifurcated market, and that plays out most clearly when we look at occupancy by product age group. So we're looking at the occupancy rates by the year apartments were built. You can see quite strong in units built since 2000 and also in the 1990s, both right around 96%. Not bad in the 80s product, 94.2%, but very weak in apartments built in the 1970s and apartments built prior to that, around 92%. And most of the apartment stock in St. Louis was built prior to 1980, and so this is what's holding back overall performance in the St. Louis market. So what that means is that in submarkets with bigger chunks of newer product, we tend to see better performance. And the best example of that is suburban St. Charles County. A big chunk of newer apartments here, and occupancy in St. Charles County very tight at 96.1%, and vacancies really haven't been a problem here now going back about 3 years, and rents in St. Charles were also up 3.5% year over year through Q3, very solid hike. And let's talk about some expectations for St. Louis's apartment market overall, and it looks like all signs point to more of the same. St. Louis just does not have the economic engine capable of producing rapid growth, and so we expect job growth levels to remain pretty modest. And as a result, we think apartment performance will remain unimpressive, but there should remain certain pockets at the top of the market that should continue to do pretty well. And that wraps us up for St. Louis. So until next time, for Apartment Market Dynamics and NPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's